because some people get confused about what the interest rates did to the tech companies, obviously in 2022 and why it was down 33%. Can you kind of clarify that and explain that to our audience of how interest rates affected those large cap tech companies?
Yeah, right. These big tech companies, even the most profitable ones, they borrow a tremendous amount of money. Well, when interest rates are 0 or 1%, money's cheap. They're going to borrow as much as they can to finance operations, to buy other companies, right? To pay off, buy more of their own stock. That's like arbitrage on cheap interest rates and then using it for growth. When interest rates rise, they borrow less money, and the value of the assets that they hold in government bonds, treasury bills, mortgage-backed securities, or other corporate bonds, that falls as well. So they get squeezed by the fact that they're borrowing less, right? They're paying more on what they own in terms of their investments, and they're not spending as much money as they used to. Now, these tech companies need to spend to grow, right? They're not just tech companies, growth companies. Let's just call them growth companies. There's a reason for a long time Starbucks opened a store on every corner. To grow, they had to recognize revenue on new stores. A lot of these companies grow really fast so they can recognize revenue, because that makes them more attractive to investors. So all of a sudden, when that money gets tight and interest rates go up and they borrow less, and they're borrowing at 4%, they're going to borrow a lot less, and the value of what they own is worth a lot less. That's why they got squeezed. Does that make sense?
Oh, yeah, I always want to ask you this. Why the hell is PepsiCo in the queues? And have we seen, what company should replace PepsiCo out of the triple Qs? Isn't that a sign that we haven't created a great company maybe since Tesla or Meta? I know it's only 1% of the Qs, but I've always wondered, why were they in there?
Why was Pepsi in there?
Yeah.
Well, I think some of it was that Indra Nooyi, who was the CEO, was on a massive growth campaign. They acquired Frito-Lay, they acquired, Gatorade. They started acquiring across channel. So their MO was growth. Coca-Cola does what? Coca-Cola is the brand, right? Coca-Cola is the merch. Coca-Cola is the syrup, but it is really a beverage company at the end of the day, right? It's almost like a commodity in a lot of ways. PepsiCo was a cross-channel, doing a multi-strategy approach. Snacks, power drinks, soft drinks, a couple of
multinational as well.
Right. Yeah. And both global companies, but I think investors perceive them very differently, and a very different business model at the end of the day.
So hit the like button, share. Let's reset the room. Headed into the final stretch of Market Mondays. I got a question for you. So being that, okay, we know invest in the stock market, long-term, ETF, index funds, dollar cost average, that's the safest way to go about it, right? We're not confident with this banking system currently. Even if we were confident, you're not going to make any money with money just sitting in the bank.
Well, 4%.
So all right, real estate, right? Even in Monopoly, and I am the Monopoly champ. Shout out to my sister. She actually just got me a new Monopoly board for my birthday.
The best.
This is a different conversation, but
I'm saying nothing.
You don't win Monopoly by having the most money. You win Monopoly by having the most property, because eventually somebody's going to land on your hotels or your houses, and they're going to have to keep paying you until they go bankrupt. So how, in a perfect world, right? Let's say somebody has $3 million. How much money should be allocated towards real estate? How much money should be allocated towards stock? Is it better to put excess cash just in real estate? Because it's tangible. It's not going to go away. Somebody's always going to need somewhere to live. And in the stock market, anything can happen.
Yeah. Great question. Great question. All right. I was doing this the other day. The real estate market, the US residential real estate market over the past 20 years has gone up an average of only 5% a year. All in. I know that sounds crazy, but if you take the entire country and the value of all residential real estate, 5% a year on average.
Median growth. Okay.
Right? Not just 5%, 5% a year on average. Not bad, not great. That same period for the stock market, so that's up, that's 5%. The stock market's up about 8 to 9% a year on average over the same time period. Now, we've had an incredible period of growth. I heard you, I think last week, Ian, talking about the fact that if it weren't for Obama and QE, the whole last 20 years of stock market growth wouldn't even have happened. Maybe not, But
Yeah.
there is something about the fact that, American companies growing big and kicking off profits and dividends that has built wealth over time. So either way, pound for pound, the stock market has been the better place for your money. Now, that doesn't mean that it applies to all investors. Some people buy real estate because they need a place to live. That's an opportunity cost, right? So you have an asset that should be growing over time, and you got to live somewhere. So it provides a function to you as well. And maybe you want to pass it down through your estate to your kids, your grandkids, whatever. It serves a lot of different purposes, whereas a stock is literally a piece of paper, not even that anymore. So think about the use case of that. Now, we asked people at Investopedia, our readers, how much they think they need to retire. What's that magic number? And then that magic number doesn't change, guys. It's about $3 million. Now, Ian's right. 10 million is real wealth, right? 10 million kicks off 700,000 in interest a year for you to live on right now. That's pretty good. But 3 million. So I think you have to have, and it depends on what age you are too. But if you're like my age, I'm going to speak from personal perspective, 52, I'm still long the stock market, right? I have some real estate assets and some private equity and some private businesses, and I have some side investments and stuff and a small business and stuff like that. But mostly for me, it's the stock market, because I'm one of those people that believes in that compounding magic, that fairy dust that's sprinkled over the stock market that allows it to grow an average of 9% a year. Didn't happen last year, but the 3 years before that, guys, stock market was up 100%. Is that going to happen next year? No. Do I think we're going to be down another 22%? No. But if we are, I think the year after that's going to be a lot better. And the year after that's going to be a lot better. And over time, that's the best place to grow my money.
My graduates from my school being Forbes, bag drop.
Bag drop.
A mic drop, bag drop.
Bag drop.